Well, let me now welcome Neelkanth Mishra, try and explore his insights on the US economic situation and its ripple effects on India's economy, given his expertise as chief economist at Axis Bank and, of course, his role in global economic analysis as well. Neelkanth, great to have you today on ET Now. Thank you so much for your time. Right. Neelkanth, I was just going through your report and, if you could firstly elaborate on this new Triffin dilemma that you've talked about and its implications on the US dollar and how it might affect India's economy.
Yeah, that is indeed the most important question. See, if you see the international monetary order, the countries have always needed a framework through which to figure out how the currencies and exchange rates will function. Till, I would say, the Second World War, though of course the gold peg had started to break even before that, there was the gold standard where every currency was pegged to gold. After 1945, it was so decided that every currency in the world would be effectively pegged to the dollar. This became effective only after 1950. And it did get influenced by the Marshall Plan. So the Bretton Woods Agreement kind of got diluted when you see what was actually implemented. But the mechanism that existed was that every currency in the world would be pegged to the dollar, and the dollar in turn would be pegged to gold. The problem with this setup is that any country which is providing the reserve currency to the world needs to incur a current account deficit. And the way to understand it is that if you are reserve currency of the world, say US dollar, I need to accumulate US dollars to signal to everyone around in the world that I am a safe, either a financial firm or a country. Now, the accumulation of dollars means that I need to provide a good or a service to the US to be able to get it. So the US, in effect, has to run a current account deficit. Now, over a period of time, as it continues to incur current account deficits, as it continues to grow its liabilities, its foreign liabilities, which is what accumulation of reserve assets globally is, over a period of time, it cannot maintain the peg to gold because it will run out of gold. It cannot have that much of gold. So this was the Triffin dilemma. Robert Triffin in the 60s talked explicitly about it. So he was against the Bretton Woods Agreement, and he said that this will not sustain, and it did not sustain. So in 1971, the famous book, The 3 Days at Camp David, Nixon says that how Nixon and his core team decided to break the gold peg. Now, the problem is that while for 7-8 years there was uncertainty after that, the world again descended into a system where the US is the reserve currency of the world, and it is actually very hard to dislodge it from there. Now, there is no peg to gold, but still everyone is accumulating US dollar reserves because it's considered the reserve currency. Now, so over a period of time, the US has continued to accumulate deficits. Today, its net international investment position is minus 90% of GDP. So you can imagine that everyone thinks it's a safe asset, but in reality, it is not. And at some point, this illusion has to be reset. So this is being called the new Triffin dilemma, that at some point, the world will have to agree for another reset, and which is what I think the Trump administration is attempting to do. Some of it can be done by the markets. Remember that this is not 1985. This is not 1971. Financial markets are much larger. I don't think they're in control of central banks. Central banks themselves may not be 100% in control of the governments. And therefore, I think the market fears themselves can actually drive a lot of the adjustment. Anyway, we are going through some very interesting times in the foreign currency market.
That will be sure. But Neelkanth, are there indicators which are suggesting that the US net international liabilities are nearing unsustainable levels? And, then the bigger question is, what could it really mean for India's trade and investment relations with the US?
Again, great question. So some of these things can keep building up. Because this is, all of these are myths. These are things that it is in everyone's interest to believe in these myths, and therefore they persist till the time that they become unsustainable. So now we see two signs why this whole system has to go through a necessary reset. And the two signs are, one, that the nature of liabilities that foreigners are holding. See, for a long time, foreigners were very happy holding U.S. treasuries, but over a period of time, I think that one, the U.S. debt to GDP, sovereign debt to GDP, kept rising. Two, there was so much financial repression, effectively the Fed doing QE, that the yields were pushed down. So foreigners started to buy U.S. equities. So between 2020 and 25, of the growth in US international liabilities, nearly 78% incrementally is in equities, with both FDI and portfolio equities. But the portfolio equity exposure has doubled. It's also because, of course, the US equities have done well, which is why you would have noticed that in this round of uncertainty, normally at times of uncertainty, the US dollar would appreciate because people were then hunting for US treasuries as a safe asset at a time of uncertainty. But this time, because they were overexposed to US equities and the epicenter of the economic uncertainty is the US currently, they sold off, and of course, expensive markets as well. And therefore, the dollar weakened when there was uncertainty. So, this is the first sign that things are no longer in a sustainable position. The second is that the cost of these liabilities is now becoming worryingly high. So this is a concept called the primary income. So just like you and I, we have assets which get us returns. We have liabilities like home loans on which we have to pay interest. So if you aggregate all of that at a country level, so the country has assets and liabilities. Now it earns something on its assets and it has to pay something for its liabilities. The net of that is called the primary income. Despite having a net negative international asset position, meaning that it had more liabilities than assets, the US used to have a positive primary income. So it earned a lot more than its foreign assets because it was investing in emerging equities or high yielding debt. And the liabilities were mostly US treasuries, which yielded 1 or 2%. So it used to make a lot of primary income. That has declined by 1.5% of GDP just in the last 3 years. And so now a December quarter was a meaningfully negative primary income. So we are now reaching a stage where the situation of continuous buildup of US international liabilities is not sustainable. So we are overdue a reset. Some of it can be done by the markets, but I think there will need to be some policy making shifts as well.
When you say there could be this 1.5% drop in primary income as a percentage of GDP over the next 4 years, as the assumption that you've made, what could be the potential impact then on Indian businesses operating in the US?
Yeah, no, so that has happened in the last 4 years. So this is not a projection. This is an observation. This is a fact. And the fear is that this worsens significantly. That as the U.S. fiscal deficit remains high, the current account deficit will remain high, despite all the adjustments being attempted through tariffs. And what that means is that the net international investment position continues to become more and more unsustainable, and the break then is much steeper. But coming to India, I think there is through the tariff route, and as we've discussed earlier, there is a slight positive impact in the sense that in the US, it is likely, and in fact, you must have seen that at the spring meetings, the Treasury Secretary talked about India and Japan being among the first to sign the trade treaties. And it is very likely that India could be among the first to sign the treaty. And given that our principal competitors like Vietnam have like unsustainable deficit, they will be called currency manipulators very likely, and therefore India at the end of this all may actually have a better channel with the US than otherwise, and that's actually pretty positive for India. On the second order effects, though, I think the uncertainty around all of this churn, the fact that investments will continue to get postponed. So despite all the excitement around US potentially backing down in order to have a negotiation with China, now the timelines have been talked about are like, June, July, we'll have the first round of discussions, and September is when maybe President Xi and President Trump will meet. So that's a very long time away, and that means continued uncertainty and therefore a slowdown in investment activity. And that can be, of course, a drag on India's externally exposed sectors. I also think that the uncertainty brought about by significant volatility in currencies, the necessary changes that may be undertaken in various markets in terms of exchange rates, the problems that will emerge on the fiscal side, because there will need to be a lot of fiscal adjustment, will all be, I think that the level of uncertainty will make sure that the equity risk premiums will rise from here, which means lower price to earnings. India's PE premium to the world is now at like a 10-year average. So I think we had gone below with outperformance over the last month. We've, I think, caught up. But if the global PE multiples continue to remain capped, I think India will have that issue as well. And at some point, I think questions will have to be asked or answered on what happens with the USD INR. So if, for argument's sake, if the trade weighted dollar has to go to say 80, I'm not saying that it is going there in a hurry, but remember that the last two times the real effective exchange rate of the US dollar was at this level was 1971 and 1985. So this was just before the Nixon shock, where the gold peg was broken in 71. And 85 was the Plaza Accord, where Germany and Japan came together with the US and tried to devalue the dollar. The decline can be quite extensive, can be much, much bigger than the 1-2% changes that we're getting used to. If that was to happen, then where does the USD INR end? I think is a much more important question. And these uncertainties are not good for markets.
So what's going to be the impact of such a weak currency, or rather, I should say, the dollar devaluation that's currently at play? What could be the repercussions on not just the economy, which you just highlighted, but firstly the currency too? Because, I mean, any foreign money, a large part of it is dominated by which way the currencies are moving in the world.
Absolutely. And in currency movements, in interest rates, we talk about basis points. In currency, they talk about pips, which is hundredths of a percent point, and or the 10,000th of a percent point. So the point is, it is the fact that we are talking about DXY already having moved from say 110 to 98, and then potentially another maybe 15-20% say over the next 2-3 years. It is a very, very, very dramatic shift. It will change many supply chains, many business models, and businesses will have to recalibrate. So it just means a significant amount of uncertainty. The question to ask here, and at this point, we can only ask questions, because remember that the US regime currently, from a political perspective, understands that the current situation is unsustainable. I don't think anyone knows what the new situation is going to be. Remember, there are going to be hard negotiations. So, for example, just like they did in the Plaza Accord, remember that a large part of US liabilities are with their allies. So it is the Europeans, Western Europeans mostly, in Scandinavia, West Asia, which the US calls Middle East, Japan, Korea, Taiwan. So if you add all of these up and you say that, okay, you know what, you let your currencies appreciate against ours, and we are giving you defense protection and all of that. So a reasonable part of the unsustainability of the NIIP, the net international investment position, can actually get addressed. So if they have, say, $62 trillion of liabilities as a country, and they have, say, $34-35 trillion of assets, Now, if the dollar already, and this is I'm talking about December 24, since then the dollar is already down about 10-12%, and suppose it falls another 15%, we are talking about a 25% increase in the international assets, and therefore what was a 27, $28 trillion gap is suddenly looking like a 20 trillion or $18 trillion gap. Move it down another 10% over the next 2 years, and we can drive the reset on which the world economy can start progressing again. The big uncertainty, of course, is China. So if the USD CNY does not appreciate, remember that the Chinese balance of payments is under severe stress. Their economy last year grew to a large extent because of exports, and their currency, if left unchecked, would actually be falling right now. The ask from other allies of the US would be to suggest that, look, let's the CNY should appreciate against the dollar as well. Otherwise, we are not playing game. And so it's going to be a drawn-out discussion, and there will be significant uncertainty. And so let's see where we land up. So at this stage, play it close to the chest. Don't make long-term bets is the only advice one can give with certainty.
And what might you think would emerge as the new world order and the new reserve currency if it has to move from dollar eventually?
See, reserve currency status is very hard to change. So remember that the establishment of the dollar as a new reserve currency in many ways started with the formation of the Fed, where the regional central banks sort of came together around the First World War and created the Federal Reserve. The Federal Reserve passed many regulations which allowed, because the US businesses were expanding internationally, it allowed for the use of dollar globally. Post the Second World War, the Europeans, in fact, the Russians, were left with a lot of dollars. The US was worried that if they came, but at that time, the dollar was still internationally pegged to gold. They were worried that if all of these dollars and people started claiming, they'll run out of gold. And therefore, they created the euro-dollar market, which is how to use dollars in global markets. Imagine any central bank, I mean, whether RBI or PBOC, or the Bank of Japan. Japan is actually quite freely floating, but allowing foreign banks, foreign financial institutions to hold that if necessary, to have 80-90% of $100 bills being owned by foreigners, having that level of confidence and that level of regulatory, I would say, scale, meaning to have laws and regulations and understanding of how this works, it is going to be very, very hard to replace. And therefore, it is when these negotiations happen, and eventually there will be. I mean, while markets today, as I said earlier, are now much bigger than states, and therefore it is going to be much more troublesome than it was in '85. Remember that the Plaza Accord was followed by the Louvre Accord, which failed, where people feared that the dollar had weakened too much. It was a few years after Plaza. Now, so today, given that markets are much bigger, there's so many derivatives, there's so many interconnections, it is going to be much harder to move currency just because some two governments signed an accord. But at the same time, I mean, there are ways of driving this extreme messaging. Some of it can be done just by talking. So as these changes come about, there will be hard negotiations, but I find it difficult to imagine that the dollar can be replaced very quickly in, say, as a currency of invoicing anytime in a hurry. And if that persists, and say there is a period of dollar weakness, say, and it would be in the US's interest to make it, say, happen in the next 2 to 3 years, and then the net international investment position settles down, they start showing some fiscal discipline, it is quite possible that they win back the trust of the world. So just like Volcker did starting 79. So 71 to 79, that volatility phase, maybe that's where we are. We're all now, refreshing our historical training or the training of economic history and monetary history. But it is quite possible that if the US in the next 3-4 years shows resolve to have fiscal and discipline, and that it is able to bring down and anchor medium-term inflation expectations, people will start trusting the dollar again. So I don't think there is any other currency right now which is in a position to replace the dollar as a reserve.
Sure. But while you're not, Neelkanth, sort of denying that we could see further correction, at least in the US dollar, tell me,
Yes.
how should India prepare for such a scenario in terms of both monetary as well as fiscal policies that could be prudent to try and wade this volatile and ever-changing world scenario right now?
So the first is, of course, that we need to have regulations and channels to handle the volatility that may come about. So, for example, if say the US dollar does weaken that much, it has already weakened by 12%. Suppose it weakens another 12% over the next 1 year. So what will happen is that people will hunt for safe assets. And remember that, I'm just giving examples. I'm throwing scenarios out that, look, there is a very large pool of FAR bonds, the fully accessible bonds, the government GSECs, which foreigners can buy. And remember that the yields are surprising almost everyone on the downside. And there are timing issues about, backloaded supply and front-loaded demand and open market operations. All of these things are, of course, helping. But remember that if, say, suddenly the foreigners were to buy $50 or $100 billion of these FAR bonds, what happens to the currency, what happens to monetary management? And so therefore being prepared, I'm not saying it's going to happen, but it is in the realm of possibility because, a lot of the things that people thought was uncertain and impossible to happen have been, those assumptions have been broken apart in the last 3 weeks. And so as we plan, as policymakers plan for this, I think that is a very important assessment. We have to be very aware of, opening up or reducing friction. So as we try to take the position that we have always wanted to, which is being an integral part of global value chains, have Indian firms or at least manufacturing locations in India, which are exporting and creating jobs in India. We need to be very rapid, very agile in attracting investments being shaken out of other countries, simplify our tax routes, and building competitive strengths, which will offset even, say, a potential, say, a decline in the USD INR rate. See, so far, all of us were reasonably sure that, say, an 83 or 84 would never be broken on the downside for the USD INR. But what if that becomes an integral part of the discussions? And in which case, which are how do we build our productivity? Or how do we enhance our productivity so that even with a slightly lower USD INR, basically a slightly stronger rupee, that the competitiveness is sustained. So I think there is a lot that our policymakers, all of us, business folks, workers, they all need to be aware that these changes are afoot. And the next 2-3 years could throw up a lot of opportunities for us.
Well, Neelkanth, thank you so much for your time today, and you've given us so much food for thought. Good speaking with you.
Thank you, Aisha. Thank you, Bharat.